Okay. And here's Mike. He's here. Yay for
Oh,
Mike.
yay.
He's going to
Oh
give
my
us so much
gosh.
knowledge today.
I hope so.
And a couple of things. So we were introduced by Abe Cool, and Mike now totally regrets ever meeting him because meeting me, I should say. And because now I've got him last minute doing CLEs for us and asked him to join the M.A.R.C.H board, and the list goes on and on. So Mike, we are very grateful for you. And thank you for presenting this information to us today.
Oh, no problem. Thanks for putting up with our technology issues. So our company just switched corporate affiliation, and today at friggin 11:30 is the day they decided to come and switch out our internet. So it's been exciting. So I was sitting here with my teeth brushed, my hair brushed, and all that stuff, ready to go. So I apologize for everyone. I'm going to try to jump right in. I will give you guys a disclaimer that this is the first time I've actually done this presentation. So wish me luck. Can you see my face or just the screen?
We can see your face right now.
Oh my gosh.
We can see you.
That's terrible. Let's see if we can fix that. So I just hit share screen. And that.
There you go.
How about that?
Yay.
Technology is not my friend today.
Doing great so far.
We're running through a cell phone right now, so hopefully that will all work out. So anyway, welcome everyone. So just to jump, I'm just going to dive right in. So the divorce and mortgage planning concerns are kind of a touchy subject in divorce situations, right? So specifically if one spouse is going to be dependent on income awarded from the divorce for the mortgage, for mortgage qualifying purposes, right? So and also when the court ordered assignments of debt are present, so as jointly held mortgage, such like that. So the mortgage on the home, if it's jointly held. Our business, divorce mortgage planning, can help identify possible solutions and assist both parties to let go of the counterproductive positions and emotions while taking stock of the possibilities, resources, and solutions during their mediations. A successful divorce settlement, I mean, we call it successful divorce because both parties end up relatively whole. I mean, that's as good as you can be. So sorry, my camera here. At least on the road, like at least on the road to recovery, right? So the question is, how do you get there? So the goal, my goal today, I'm not going to try to teach you guys how to do mortgages or anything. I know that's our job, and that's not your job. But we would like you to have a basic understanding of how we, divorce mortgage planners, look at the various aspects of divorce and how they have a significant impact on the success when there's real property in the marital home are front and center. We kind of look at it as 1.1.3. This is how we get it. 1 + 1 is greater than 2. That's kind of our little logo thing. So before I get too far in it, I'll tell you who I am. My name is Mike Foote. I'm a sales manager at AFN, American Financial Network. That's a new company that we just decided to switch our internet today. I started doing mortgage. I did my first mortgage back in 1997. I'm a member of the Divorce Lending Association. I did I have a whole new respect for you guys because I did complete the 40-hour mediation training. And I just thought it was like not that big a deal, but it was really a lot more intense than I thought it was going to be. So my goal here today, like, to get you guys to use me as your resource. If you guys need anything, we work for free up until my company pays us to close loans. So we don't charge customers, we don't charge you guys anything like that. So we're basically your resource when you run into any issues like this. If you have any issues, mortgage questions, or some kind of concerns or something about because we have so many scenarios, everything is so different. Just you can call me, you can email me, all my contact information will be at the end. But really, I am 100% committed to you and your business, help you guys grow. get everything's done in 2022. Being an advocate means that you're a person that publicly supports policy or cause or whatever. So we're not advocates for divorce. I was actually a child of divorce, so I don't really wish that on anyone. But and I've been married personally like 37 years, so I've never been through a divorce personally, but I've been affected by it a lot. Got family members and stuff. So but we do believe that like through knowledge and education is a big thing, that mortgage professionals can bring value to their divorcing clients. Our main thing is we kind of want to give them good service, extra service, because they're already going through this divorce situation. So the intersection between divorce and family law, financial tax planning, real property, and mortgage planning is real, and we can't ignore it. So we, as mortgage professionals, I personally, with my sales team, I challenge everyone to become part of the solution, right? And raise our level of service when we're working with divorcing clients. So a lot of loan officers don't understand what they're going through. They just think it's just another loan that they're going to get. So I'm just going to jump in. This little puzzle piece thing that we like, I like using this image because it shows the four major pieces of the divorce puzzle. Let me move my screen here. Divorce law, financial tax planning, real property, and mortgage planning. So this kind of shows how they're connected, but it also really shows how disconnected they are. So it's the disconnect that usually causes the harm to divorcing couple. So like from a legal, financial, and even emotional perspective, right? So let me give you a better picture here. This is kind of more intertwined to this thing. So this kind of makes you cross-eyed. But if you look at everything involved in and how it intersects with divorce, real estate, and mortgage planning, all these things are all intertwined, and it really is a complicated thing. So when the home's on the marital balance sheet, this is what it can really look like. Excuse me. This example really only takes into consideration a small fraction of the overlaps and the need for someone who's knowledgeable and strong professional divorce team. We want to be part of your team. So it's because it goes way beyond just one spouse retaining the home and hold on there. Let people in. It just goes way beyond a spouse retaining the house or just selling it. So there's a whole lot more involved in the overall picture. In the areas that overlap, they affect way more than just a divorcing couple. So it can impact how each member of the divorce team does their job, whether it's the attorney, the financial planner, divorce mortgage planner, whatever. So for all of us involved to provide a higher level of service to divorcing clients, it's really kind of imperative that we all acknowledge how the home can impact multiple facets of not just the divorce, but life after divorce. That's kind of where we're going, is try to make things better after. So let me click on here. What makes a successful divorce? I'll ask it again. When you put the four pieces of the puzzle, the divorce puzzle together, because successful divorce mediation results from like communication, effective communication, strategic negotiations. Like I said before, so the divorcing parties come out of mediation whole, or at least semi-whole, or best they can get, on the way to recovery, right? It's better than they were, hopefully. So CDLP, like this may be the first time, a lot of people don't know what a CDLP is. CDLP stands for Certified Divorce Lending Professional. It's a certification that we get. We have to attend, to get the certification, we have to do a 40-hour on-site training. And it's pretty intense. So, and by the way, I guess I didn't touch on that, but I think Dawn's monitoring the chat. Is that right? Are you doing that? Because I hope you are.
Yes.
Okay. So if you have questions or whatever, if I sound like a rambling idiot, then just holler at us, let us know. Anyway, like, so one of the questions that I get most of the time is like, what's a CDLP? What's the difference? And why is it different than just my mortgage guy down at the bank? I mean, it's a fair question. So what I would say to you, and why I usually tell most attorneys, is that it's the same as you guys. So if you're an attorney, if you're a family law attorney, how are you different than a criminal attorney or bankruptcy attorney? It's the same thing. If you're a mediator, why do people come to you? Why do divorcing couples come to you? Because it's our background knowledge and our training in divorce. So it's kind of, CDLPs are divorce professionals. So we're divorce professionals. We just do mortgages too, right? So we seem to do that. So what we do is we work directly with you and the divorcing family to dig a little deeper than just doing a regular cash out refinance or whatever, to, so we can examine the opportunities and maybe their home equity solutions, because it's just things are a little bit different. So you can't think traditionally when you're working with divorce and mortgages all together. So our background knowledge and training that we go through, we like to think we're truly a value add to your divorce team, and we help your divorcing homeowners go. Sorry, I'm trying to. So here's a few things to think about. So this kind of illustrates my comments about not thinking traditionally. So just kind of look at these questions, because the way you may approach the answers is going to have a little different effect on mortgage planning. So for example, like if you look at these questions of how they would apply to the marital balance sheet and the distribution of assets, debt, and income. So just like this, like one of the main questions we come across is the how do they determine the value? Like that seems to be a very common issue between the attorneys and the divorcing parties. One spouse always thinks the house is, the one who's trying to get out of it, the equity, always thinks the house is worth a whole lot more than maybe that it is. So I guarantee you, like as a CDLP, we look at these questions a whole lot different than you as an attorney or a mediator might look at them. So, and I'm trying, if I'm talking fast, because I'm trying to catch up, make up for lost time. Hold on a second. If I need to slow down, tell me. I had a lot of coffee today too. So what is divorce mortgage planning? It's way more broad than just divorce lending, just doing mortgages. So there's a lot of loan officers out there who claim to be divorce lenders because they've done a loan, for people who are doing divorce. Like we've all done that. But it's much broader than just someone who, collects the documents and does the loan. Because like I said, in the mortgage business, that's what we all do. So what we'd like to think is it's a holistic approach to the process of evaluating the mortgage options in the context of the overall financial objectives as they relate to the divorcing situation. So, whoops, I don't know what that did. Sorry. Our role as a CDLP is to help integrate the mortgage selected into the overall long and short term. So we're trying to look at the big picture, but we look at everything: taxes, interest expense, and cash flow. And our goal is we're kind of educators. So our mission is to help divorcing homeowners make more informed decisions about the home and the home equity and the property and all this stuff during and after the divorce. During and after the divorce is the main thing, because we want to make sure that when everybody comes out of it, it's never going to be okay. It's never a good situation, but at least hopefully we can put them in a little bit better spot if we plan before the settlement. And this is a very important thing. We do not give legal advice. I stay in my lane. I do not give legal advice. I do not give tax advice. I just don't. Not my job. That's you guys. So here's the 4 phases of what we do, the divorce mortgage planning. So we have vetting the house, qualifying the income, the debt analysis for the consumer debt analysis, and home equity solutions. So the vetting process of the home and any other real property they have. So it goes beyond determining what the value of the property is, or whether it's marital, non-marital. So we look at hold on a second here. Sorry. I'm scared to death my computer is going to go offline again. So we're going to look at the ownership status, the tax status, the value, the equity, and we need to examine into the details because there's a lot of other details that are vital to you as the attorney or mediator. But the details also determine the real property, what kind of mortgage financing available, right? So it has nothing to do with like credit scores, income, any of that stuff. Just there's a whole lot of different options. So we also analyze the various income sources, employment, support, income or no income, and things we can do to create qualifying income also, maybe with some financial and tax planners. So how is the marital or individual debt being evaluated? How can we help divorcing homeowners make more informed decisions about the home equity solutions? So it's a little bit more intense than just like call this guy and get a refinance. So we like I said, I kind of say it a lot, as we can't really think traditionally when we're working with a divorce, real property, and mortgage financing when it's all combined in a thing. So we all bring different perspectives to the table. Hopefully we can all work together and we can fix the problem for the divorcing homeowners. So one of the main things, like, so we've always been told, like, I've been in business forever, and there's 3 C's to lending: credit, collateral, capacity, right? So the credit is obviously the credit, their collateral, the house value, and the capacity to repay the loan. So one of our main areas that we have to look at is income. So the biggest takeaway here is that not all income is considered qualified income. So, and this is one of the biggest things that we run into with divorcing clients. So I want to try to provide a little clarity on how we look at income, so to help you guys. So when we're working with the divorcing clients on mortgage financing, we have certain requirements we have to meet before we can use the income source for mortgage qualifying purposes. So they have to meet the stability and consistency tests. It's also hard a lot of times for the client to understand, and they get real frustrated sometimes because, like, they know they have the money, they know they have sufficient income, or they got cash flow every month, but then we end up like tearing it down because we have to determine the income source and if we can use it or not. So sometimes we can't use it. So we also may have like employment gaps. So maybe the borrowing spouse has stayed home as a primary caregiver for a long time, and I shouldn't say she, but they have maybe they just went back to work recently, right? So that's a whole nother issue. And then now 2022, 2021, we've got COVID. COVID kind of threw a curveball in there too, because there's gaps in employment due to layoffs and terminations and things like that because of the pandemic. So any type of support income has to meet its own tests for use. So even down to like the name they give it. And I mean, seriously, if it's alimony, maintenance, and spousal support are treated differently, believe it or not. So in the mortgage world, so the CDLP can help make sure they're tied together through verbiage in the MOU or settlement agreement when we're part of your team, when we help you guys out. We've seen a lot of divorces in the last couple of years where there's a lump sum payment instead of monthly support payments. So, which is awesome because you've got a big fat bank account, but sorry, I paused. It keeps popping up a thing saying to let people in. So I'm letting everybody in. No guidelines. I'm the worst bouncer ever. So you got big money, right? You've got a big fat bank account, but you don't have any income, so we can't count that income. So even though, like, I had a lady who had $2 million in a bank where they split up some stuff, and she can't use any of it because she doesn't have the income. So what we do is, like, we're trained to work with the divorce team to come up with solutions for those situations. So support income is probably the most challenging one, because it can create a whole lot of little, I don't know, rabbit holes to go down. So the same requirements are in place for spousal support and child support. So basically what we have is we call the 636 rule. So easy way to remember that one. So in order for spousal or child support to be considered as qualified income, we have to show typically 6 months receipt of the income, and then 36 months continuance after, the key word here, after the loan closed. So the problem becomes, is like, when we have spousal support is only awarded for 3 years. By the time we show 6 months receipt, we don't have 3 years anymore after the loan closes or whatever. We have to, so we can't use it. So we try to stretch that out, try to talk people into stretching it to like 42 months or something like that. But the same is child support. So we have the 636 rule for child support. One of the most difficult things that we run into with that is, say you've got 2 kids, we've got 2 children, one's 12, one's 16. Support ends when each child turns 18, right? So if it's a lump sum and we don't have any way to distinguish how much it's going to be after, say, the first child turns 18. So if the settlement agreement doesn't clarify what the future amount's going to be, then our underwriters are going to reduce the child support, probably most likely by half. So they're just going to say it's 50%. So, and it may not be that. So it may be that you have one kid is, 100% of that money, 20% is going to 180 for the other or something, so you just have to be specific in that stuff. So another hurdle we face, yep, we're good. Sorry, my internet guy. With support income, other than the 636 rule, is documentation and receipt guidelines. So it has to be, so we have to meet 2 specific criteria, right? It has to meet our standards for consistency and stability. So basically, it has to be paid as ordered. So if the order says spouse A has to pay $1,000 a month in spousal support to spouse B by the 5th of every month, spouse A pays $1,000 in various amounts all through the month. I mean, we've all seen that. There could be an issue, right? So, and inconsistent payments in order to use spousal or child support or qualified income, it's got to be paid in full as ordered and on time. I mean, so that, and I've got some underwriters that are a little flexible on that stuff. I just did one right now, but when you get someone who, it's supposed to pay $900 by the 5th of the month, and they pay $700 one month, and they pay $1,000 the next month, and then maybe he pays on the 5th, maybe he pays on the 20th, maybe, whatever. We run into problems with that, and people don't understand it because they're getting the money, right? Excuse me. So the other thing is, like, let's talk about documentation. Sorry, I'm hung up here. In documenting like the 6 months receipt, we have to have a paper trail. I might have clicked too fast. We have to show copies of the check deposited, which is obviously, that's easy. But now people are doing a lot of stuff electronically, right? So even that's pretty clean because we have it on the bank statements or something like that. But the hard part is when we have to show, provide proof that the party transferring the money is indeed the former spouse, which requires that we have to show ownership in the bank account where the money's coming from, right? So now you run into a whole other issue, because how many ex-spouses do you know that want to give their ex-spouse a copy of their bank statement, right? Not very many. But just for the record, I don't need a statement. I don't need a bank statement, a current bank statement. I can use the ones that you guys use during discovery phase. That's a side note, but all we have to do is verify that the name and the account number, that's where it's coming from, and that's who owns it. So, and then we see people who have an issue transferring money from their personal account to the ex-spouse's individual account. So then they say, okay, well, we're going to transfer money to a joint account, and then the receiving spouse transfers the money out. So in that case, like, you can't use that, you can't qualify that income at all. It's not qualified income, because in essence, what they're doing is they're paying themselves support because they're on the account, and you can't pay yourself support. So that's effectively what's going on. And then there's another situation we run into is netting out support payments, right? So trying to see what we're doing on time. Okay, we're good. So here's an example. I had an attorney recently, very similar situation. The husband during temporary orders was ordered to pay the wife $9,500 a month in monthly support. So, but out of the $9,500, he was supposed to pay the mortgage, utilities, and medical expenses directly. So, and then he paid her the remainder in cash. So she's supposed to refinance within whatever the time frame was, certain finance, and after the divorce is final, I think it was coming up March 1st, February 1st. So we can't use that income received during the temporary orders because it doesn't meet our requirements for stable and consistent income. So if you ever run into this, if you get into one of these deals with one of your cases, then it's cleaner, easier to pay the full amount, just have the one spouse pay the full amount, and then have the receiving spouse pay the bills directly. So basically what we're trying to do is create a paper trail, even if it's paper, it's electronic or whatever, a paper trail to find that. So from a mortgage financing perspective, so if we go in early and we can, while we're doing the settlement, say, hey, like, this is what we need to do before the divorce gets out, then hopefully we set the expectations, and we can all be more successful. The divorce. Okay, so here we go. Anybody awake out there? A poll question. What is the 636 rule? You can put your answers in the chat. Can I see the chat? John, I was just looking at your chat, John. On the annuity, now I'll kind of get into other, you could probably do that. It would just have to be, you still meet the same requirements as like the 636 rules if they're going to do that. Oh man, you guys are killing it. I don't know how to move the screen over here. There we go. I hate looking at myself. Oh, it's like 100%. Everybody's got this right there. Okay. Let me see this. So am I working here? There we go. Not sure what that was all about. So lastly on there is on the income sources, it's like a lump sum payment in lieu of monthly support. So, and we do run into this quite often when we're trying to get mortgage financing for divorcing clients. So if you got a spouse that got $500,000 lump sum payment and wants to buy a new house or refinance the home, the marital home as ordered, but they aren't employed, or they're not receiving any support or anything, even though they got $500,000 in the bank, they've got no income. So and there's not a lot of options. I mean, there are people who will do loans for those, but I guarantee you when I tell that person that has $500,000 in cash in the bank that they have to get a non-qualifying mortgage that's, you know, a 6% interest rate or something like that, they're not gonna like it. And I have, that's how I know. Let's see here. So there are some options, so we can amortize those assets over a period of time. So even those options though have requirements for the type of account the funds are in, whether or not there's a penalty for accessing them and all that stuff. So a couple of options are creating support that meets the minimum income requirements and continuance to qualify. So as I just said, we have 6 months proof and 3 years continuance, but we can do like an alimony trust or a revocable living trust. So we can do either of those, and it stipulates the amount of payments. And then instead of maybe that whole payment, that whole lump sum payment, we fund the trust and then to put out distributions every month to create qualifying income, right? So there's options. There's usually always options, but it just kind of depends on the urgency of the client, what they're trying to do. But the key thing that we try to get you guys to take away from all this is that the key for all of this planning is to do it before the divorce is final. So we don't. Let's see. Sorry, I'm not the best on this Zoom thing. Technology. So, how much time we got? Trying to keep track of the time to keep everything rolling since I slacked off the internet today. So the other issue we have is debt, right? We always have debt, not always, but we have to divide the debt. So if one party is ordered to make a payment on a specific debt, it's considered a court-ordered assignment of debt or a contingent liability. But in order for this debt, like say a mortgage, so one spouse is retaining their marital home and not going to refinance it. So for that current mortgage not be included on the vacating spouse new mortgage, so the vacating spouse wants to go buy a new house. So in order for us to not include that, there's specific verbiage that needs to be in the settlement agreement. So understanding how a court-ordered assignment of debt help the spouse, right? So we want to make sure that that's very clear. So same if you're maybe a joint debt, right? So there's sometimes we run into that where they're both going to pay shared debt. It's going to be shared between the spouses until it's paid off. So then it needs to be specific on as to how the payment's going to be made. So if it's not clarified that both spouses are going to pay 50% of the monthly payment until the debt's paid off, then each spouse is going to be hit for 100%, whatever's on the credit report. So, and same with student loans, right? So if they've got a Visa bill that's got a $200 payment on it, and they agree to split it, if you specify it in the agreement that each one's going to pay 50% until it's paid off, then when we go to calculate their debt to income ratio, I'm only going to count half of that, right? But if not, I have to count the whole thing, which, you know, may or may not work. It depends on the specific issue. But a lot of these times we have one spouse that's making a whole lot more money than the other one. And so when we're trying to qualify that other spouse, we need all the room we can in their calculating their debt ratio. Like I said, student loans are the same thing. So sometimes we need to spell that out and look at it to put them in a position so they're in a stronger position, I guess, for mortgage financing. So, I mean, I can't stress enough that clarity in how the verbiage is used can make or break it, the mortgage financing. So I don't know if you guys have ever had one come back and you go through the settlement, you do everything fine, the divorce is finalized, and then a couple months later, the spouse that was supposed to refi the marital home to get the other one off the mortgage, they can't do it because that spouse's income is either insufficient or they got too much debt or something like that. So now, and it's not spelled out properly. So now the vacating spouse is stuck because this is on their credit report. And they, depending on if the verbiage isn't there, then they can't qualify for a mortgage either. You know, and they come back to you and you're kind of like, well, what am I supposed to do? Like, I don't know what to do. It's all done. So here's poll question number 2. Court ordered assignment of debt is a court order that specifies which spouse or party will be legally responsible for paying a specific debt and may allow for the current mortgage to stay in place while not counting the existing debt against the other spouse trying to obtain mortgage financing. True or false? Go in the chat. Ready? Okay. I have to make sure you guys are still awake. Try and talk fast because we only got like 15 minutes left. So. Friday. Yeah, so the answer is true on that one. Well, here we go. I'm not even sure what I just did. So let's talk about the actual house itself. And just for the record, I don't drink, so all this is self-induced. So when the spouse is retaining the marital home and acquiring ownership interest of the other spouse by paying them their share of the equity through a refinance, it's referred to, we call it an equity buyout. It's not a cash out. I'll try not to talk with my hands. It's not a cash out refinance. It's an equity buyout, and there's a difference. So the term confuses people because a lot of people think it's a purchase loan. It's not. So even if the spouse who's awarded the home is not on the current mortgage, it can still be done as a refinance, which makes a lot of difference because you don't have to have a down payment and things like that. So people think that an equity buyout is a type, you know, I say refinance, but it's really not type of refinance. It's actually just a legal aspect of how the equity is structured and how it's divided. So just because the court might order one party to refi the current mortgage, the court can't tell them what kind of loan the party has to use. So it may be a refinance, but there's really 2 types of refinances. You have rate and term, and you have cash out. So again, the verbiage in the settlement agreement needs to be specific, but there's certain aspects of the real property that can also trigger the use of a cash out over a rate term. So the big deal is why you want to clarify and you want to get it as a rate term refinance is because the rate term mortgage gives them way better terms. It's better. They get better rates and they also get to access a higher amount of the equity. So usually that's where we're at anyway. We need more equity in the property to pay out the vacating spouse. So if we have to do a cash out, it's considered a cash out mortgage. The rates are higher and we can only go up to 80% of the value of the home. So if the spouses have 30% equity in the home, the vacating spouse is awarded 15%, then the retaining spouse is only going to be able to access 10% of that if it was a cash out. And the same thing with the vacating spouse they may need that money to buy a new home. So that's kind of one of the reasons that we like to use us help out in the beginning on that before we get before it's a done deal. Let me see. Oh, I'm having an issue here. A few of the things, there we go. A few of the things we need to make it happen to help position the borrowing spouse to get better financing when refinancing the marital home. So one is the terms of the equity buyout must be addressed independently in the settlement agreement. It can't be equalized with the other asset distribution. So no debt consolidation. Independent means like independent. It has to be independent there. The other is no cash back to the borrowing spouse. You can't have debt payoff. You can't have attorney fees, nothing. I mean, literally $1 cash back. They can't have it. we have to go in and lower the loan amount or something to make sure that happens. But the borrowing spouse cannot have any cash back. And then the other big kicker right now is COVID. Another curveball that they threw us was we have a lot of homeowners that have put forbearance agreements with their lenders, right? So that's a whole different issue, because now in order for someone to refi that house, they have the forbearance agreement has to be stopped, ended, and then they have to make 3 consecutive current mortgage payments before you can refinance that house after that agreement is stopped. So they have to get out of forbearance and then make 3 monthly payments on time. Then they also can't lump sum it. They can't pay the whole thing. They have to make boom, 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 3 months in a row. So yeah, that's one of the other kicks we run into. Actually, we're running into quite often, because I think a lot of them have financial trouble and then they go into forbearance, and then that doesn't fix the problem. Marital thing. We also got inventory shortage too. So that's kind of a major problem right here in Kansas City anyway. So but it needs to be specific for both spouse. What the heck, man? Sorry. I think I keep clicking something here. So the verbiage needs to be specific to benefit both spouses, right? So if one spouse is retaining the property and is going to be responsible for paying the mortgage or refinancing. So let's make sure that we address like all of the property expenses, not just the principal and interest. So, and make sure that the equity payout is clear. If you get a divorce appraisal and state a specific dollar amount to the paid vacating spouse, just note. So this is like a big thing. If the attorney you order you decide that that's how you're going to determine the values, you guys are going to order an appraisal, or you're going to get a broker's price opinion from several real estate agents or something like that. And then you state a specific dollar amount that they have to pay equity based on that. So the lender, from when Dodd-Frank came out, the lender can only use a lender-owned appraisal. So as a lender, I have to order my own appraisal. We order them through a third-party appraisal management company. We don't have any control over it. We're not allowed to talk to the appraisers, any of that stuff. So that's the appraisal I have to use. So it doesn't matter if your appraisal comes in at $500,000 and mine comes in at 400,000. Like the one that I have to use based on refinancing is the one that we own. So that's a big deal. So it's you kind of have to figure that out. And I know nobody likes to do it because it's kind of a crapshoot. It's kind of a wild card because we're at the mercy of this appraiser. So we don't know. We just don't know. And that's how we live right now in this, in our business. It's everything that we do. But at the end of the day, if you base your thing based on an appraisal that you guys get, and then the appraisal from the lender comes in lower, like that's it. The lender's going to do based on that appraisal, and that's all they're going to do. They're going to do 90% of that. So the other thing is a realistic time frame, right, for the mortgage financing. So we see settlement agreements that come in and say they're going to refi within 90 and 120 days. But if we need support income to qualify, then like there's going to be significant issues, because if you can't finance it, they can't finance in the time frame of that, because we have to verify that, like I said before, the 636 continuous. So I have to verify 6 months worth of support income to qualify that borrower. Then 120-day refinance time frame is not going to work. And I don't want to have somebody have to sell the house or something because they can't meet those time guidelines. So, man, my mouse is so touchy. I'm sorry. And there's another big one. Rarely do we ever see the current escrow account addressed in the marital settlement agreement. So, there could be $5,000 or $10,000 in there, and the kicker is like the current lender is only going to refund that escrow account to the party on the mortgage, currently on the mortgage, right? Whoever's on the loan. So and those escrow, most of the time we pay those, you know, at the end of the year, for the previous year, for that year. So those are already put in place, to pay the existing tax liabilities and insurance and everything. So those are really jointly owned. So they really need to be addressed, right? You need to really be careful of those, because we see a lot of those where it comes back and only one person's name on the mortgage. The other person's awarded the house or something, and here comes this big check. And now the one person says, well, I got it. It's my check. It's got my name on it. And they cash it out. So it needs to be addressed. So what kind of mortgage is an equity buyout? Put your answers in the chat. I'm gonna take a drink of this. I think my heart rate's come down a little bit though. My God. I don't drink, but I was thinking about starting again today. Terrible. Like my mouse just like keeps, I touch this thing. So the answer is A, right? So it's a rate term, which lets you get like 90%. That's the kicker. It'll let you go to 90% of the value of the property. How much time do we have? And I gotta see. Dawn, is this going to cut us off right an hour, or we have?
Nope, we have
Okay.
Technically all the time in the world. I was thinking at 1 o'clock we could wrap up the quote unquote presentation point, and if anybody wanted to jump off, and then if you wanted to answer direct questions at that point, would that be okay?
Yeah, I'm actually gonna, we got a thing that it kind of shows the report that we give out, but I'm just gonna kind of, because it's what, 5 till, so I'm gonna kind of blow past a bunch of this stuff since let me get all of that nonsense. But so let me see if I can do this. Again, I apologize for all that, but you know, what fun would it be if it wasn't my first time and everything didn't go to hell right off the bat. So so, and basically if we want to do that, we can just spend the last 5 minutes if someone's got some questions that are really easy for me. The main thing we do, you know, we try to do, and my why, right? So the whole reason that I really was attracted to moving into this niche part of the industry is because I had so many times been on the receiving end of after it's all said and done, and the spouse has to refi within 6 months or whatever, and they come to me and they have a settlement agreement, and the divorce, everything is ordered, and it's just, we can't use it. So that, like I said before, the income or the value, or they say, I had one not too long ago where it said he's going to pay her $25,000, and by X date, well, when we went to do the appraisal, and of course, one of the parties was a real estate agent, the one who was the vacating spouse. So she was pretty sure that house was worth a whole lot more than it really was. So they said, we're going to pay $25,000. When we did the appraisal, we didn't have $25,000. So there wasn't $25,000 worth of equity in there. And they had done it. And it was, so if it's in the divorce settlement, then it's a judgment pretty much on there. So we had to jump through a whole lot of hoops. We had to get him, he had to go sign a whole separate promissory note to her, and we had to get a partial release of the judgment, and we had to do all kinds of stuff. So and even then, like, the house technically wasn't really worth that. So our big deal, you know, kind of as I showed earlier, was like the intersection of all of these divorce and financing and things like that. Our deal is we want to help everybody out. We want to be part of your team. Like I said, I'll show you the other thing too. One thing that I like to tell people is ECOA, right? So we don't charge fees. I don't charge fees. I don't charge, I mean, nothing. I don't charge consultation fees. I don't charge whatever. I get paid by my company when I close loans. So everything that I do, I've been doing it for years, and we work for free up until the time that we close the loan and the thing is free. So that's one thing I always want to tell you guys, that we don't charge you, we don't charge them. I mean, we can't by ECOA. If I charge one person, I got to charge everybody. It's a major deal. So, I like you guys use me as your resource. You got my phone number. I'll put it on the end here. And my email address. I really would, if Donald, I'd just like to add everybody to, we have a newsletter that goes out every couple of weeks. It's full of valuable information. You can unsubscribe to it if you want anytime, but it's really got a ton of information. So I think if I'll take the thing and sign people up for it, everybody who was on the call. And again, if you have questions, you can email me or call me or text me anytime. I usually answer my phone all the time. If you guys have a bar association or something that you want me to try to do a presentation for, maybe in person, I'll have better luck. But there's all my contact information, and I just fire them away if you guys have questions. Let me see. I'll look at this chat.
So right now, so as it stands, it's 1 o'clock, but for those of you that you want to stay on and ask questions, feel free to do so. Just some real quick post-training items. I will be sending an email. It's going to have the Missouri bar number for the CLE approval. It's going to have a Kansas affidavit. Those are for Kansas approved mediators. It's going to have a SurveyMonkey link. And then I will include Mike's information in that email as well. And so you can contact him directly. And Mike, thank you for doing this today. Thank you very much.
I appreciate it. Sorry for the chaos there at the beginning.
What's life if we don't have
chaos,
right?
I was just like, I can't even believe it. I almost stayed home. I was just going to stay home and do it from my office, but I was like, no, I'll come in here. I got my stuff in here. So yeah, this felt fun, right? Stanley asked, where's the prenup come in? It's kind of, if we do like, I'm not sure what you're talking about. Like if we have if we're doing support or child support or spouse support or whatever, I don't know. Well, no, that you're talking about a prenup as opposed to temporary orders. I don't think that the prenup really fits into ours unless there's something that would come up in the divorce agreement that our underwriter would find, and if it like referred back to the prenup, then that might be an issue. I've never run into a prenup being an issue on that, but our underwriters will dig through a divorce settlement agreement, child support orders and things like that to find. They love to dig up stuff that they can throw a wrench in our deal. But temporary orders is another issue. Like, so if sometimes we like to encourage, if they're going to pay spousal support or child support, we like to encourage them to do temporary orders and start paying on there, because once we get everything finalized, that 636 that we need, we can start that with temporary orders. We can start that with, so then if the process takes 4 or 5 months, we only need to show a couple of receipt of a couple of payments to meet our 636 rule, and then we're good to go. We don't have to wait the whole 6 months to refinance or purchase or whatever. So what else we got on here? Thanks, David. Yeah, Dorothy, I'm licensed in Kansas and Missouri, so work with anybody anywhere. We can send, like I said, you can call me or text me or email me, whatever. I'm kind of old fashioned. I answer my phone when it rings. But I'll definitely help out anybody who needs it. So I'm old too, old and old fashioned. Maybe that's what it is. What else we got? I think I'm going to go eat my lunch. Dawn, thanks for having me.
Thank you for doing this.
I'm sweating. I had a jacket. I was going to be like really nice.